I know it's priceless, right? But where do you start when putting a price tag on your business? We'll find out. Then, do you need disability insurance? And why you should get a marriage agreement. All this and more on today's episode of The Wealthy Life. Welcome to The Wealthy Life. Is business succession on your mind? Business valuation expert Ernest Bednarz is with us today to share what you can do to start and how to proceed. Ernest, welcome to the show. It's so great to have you here.
Thank you for having me.
So why should people get their business valued?
Well, you need to quantify the net worth of your business. You need to know what it's worth.
Well, it makes sense, but why is that important?
Well, if it forms a big part of your financial assets, and it's something that you're counting on when you go to retire or when you sell your business, and your value is quite a bit different from what you're expecting, that's going to create a big hole.
Well, that is a very important thing to consider. It's just like when you're retiring, maybe you want to sell your house and downsize. It's kind of important to know what your house is worth.
Correct.
So how often do people get their businesses valued?
Well, it's not something someone gets up in the morning and goes, I wonder what my business is worth today. I should give Ernest a call. Usually it's led by a triggering event. Either really good things are happening or bad things are happening when people need a business valuation.
What are some of the good things?
Well, some of the good things we're talking about today is, succession planning, retirement, perhaps passing the business on to the next generation, which Revenue Canada requires a fair market determination, even if there's no money being exchanged hands.
Oh, so you can't just give it to your kids for free.
Correct.
Well, you could, I guess, but the government's still going to tax you on it.
Yeah, they still want a piece of the action there. And then the bad things are, shareholder disputes, divorce, maybe an expropriation, loss quantification when there's an insurance claim, things like that.
Okay, so there's lots of reasons to get it valued. And how do you get it valued? Do you go to an accountant? Do you do it yourself? Do you hire a professional? Of course you're going to hire a professional.
Well, a chartered business valuator is the gold standard in Canada for business valuation as being independent, objective, and trained to do business valuations for all these purposes. So
what does a typical business sell for? Like, what are the variables? What do you look for when you're valuing a business?
Well, small to medium-sized enterprises, which is typically what we see here out in the West Coast, we're talking about private companies, are valued based on their earnings or cash flow.
Cash is king.
Yes, is what is the business generating in income and cash for the owners? And it's the risk associated with those cash flows and the growth rate of that business is what really the variables that are moving the value.
Right, because if I was going to buy a business that had attractive cash flow, I want to make sure that cash flow is going to carry on into the future. And if I think that cash flow is going to increase, I might even be inclined to pay more. But if I think it's going to decrease, then not so much.
Exactly. And we look in the rearview mirror to try to predict the future because value is always prospective. But a business plan, revenues that are reoccurring and predictable lower the risk factors or the rate of return that's required to make that investment, and therefore the value increases as well.
Okay, so if I'm a business owner, what are some things that I can do today to help increase the value of my business over the next few years? Well,
let's start with the top line revenue. Make sure that revenue is consistent, that you can incorporate a recurring revenue model into your business, something that someone's paying you on. So think of a subscription where someone's paying an equal amount every month for that service. So you know that the cash flow is predictable, when the ups and downs are going to be, and what it's going to be next year, and makes also switching costs to your competitors more less attractive to your customers.
So do you have an example of a business model that has a really successful recurring revenue?
Well, traditionally, an accountant typically charges by the hour, and their billings are lumpy, especially around tax time.
Yes.
Lots of hours, lots of billings. We worked with this accountant, and what his business model is, he charges his clients an equal monthly amount, equal to what they would pay in a year, but they're doing it consistently throughout the year. So it's easier for them to pay a smaller bill every month than it is to pay a big bill at the end of the year. And the accountant's cash flow is more predictable and it's not lumpy.
That's a great example to use. Now, I think of a business owner maybe wanting to sell their business to retire. How far in advance should people start planning that aspect?
Well, minimum, we're talking about 3 to 5 years, because even if you get a baseline value today and it's short of where you need to be, and there's a plan and changes that you make into your business in order to increase the value over that 3 to 5 year period, it takes time before it translates into the financial statements.
Yeah, and I think of one big risk is the redundancy. You want to be redundant, and most business owners are not. If the business relies on that business owner being part of the business every day, all day going forward, it's going to be pretty hard for that person to sell.
Yeah, it's very hard to transfer a business that requires the owner to be there every day, make decisions, everything being centered. So you want to make yourself redundant. Have a management team in place, codify the business so someone can pick up a manual and say, this is what we do, this is how we make money, and they can run even if the business owner gets hit by a bus tomorrow.
That is fantastic advice. For those of you out there who don't have a procedures manual for your business yet, highly recommend getting that done, because then that is a training foundation for the next owner.
Yes.
So what is the one thing you think that business owners should do right away?
Get your business value today so you get a baseline of where you are.
And business owners, I'm going to challenge you to get your business valued within the next 90 days. Ernest, thanks for being on the show today. Great to have you here.
Thank you. It was a pleasure.
And don't go away, because when we return, find out the importance of disability insurance.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
What happens to your financial situation when a medical condition prevents you from working? Insurance specialist Karen Orser joins us today to explain why disability insurance can protect your wealth. Karen, welcome to the show. Great to have you here.
Thanks, Sybil. Great to be here.
So you've been in the insurance industry for close to 2 decades already, so I'm sure you've seen a lot of things and have a lot of wisdom to share with our viewers. For today, I wanted to focus on the topic of disability insurance. Why is it needed?
Well, I think the biggest thing with disability is out of all the insurance, we can protect our house, we can protect our car, but what about protecting our biggest asset? So I think for every family, every person, every Canadian, their biggest asset is absolutely their income. That's what provides for everything. So sometimes we have house insurance, but we don't protect our biggest asset, which is the ability to make income. And so to me, disability, if you can't work, you can't bring in that income and you're not covered, then what can you pay for, right? Like all those bills are going to add up. And, if you had to make a choice between losing your house and losing your income. But
I don't want to lose either of those.
Yeah, exactly, for sure. But, for sure. And, but most people would say, well, if I have my income, I can buy another house. Right.
And you can still put food on your table because everybody needs to eat.
Yeah,
but when you're unable to work and you don't have that income coming in, people then do have to start selling assets, whether like it's their house, like you say, or dipping into their retirement fund. What type of implications would that have on people's future?
So that's a really big one. And I know, when we're younger, we don't think about this stuff, but I think what market this really attracts is, those people in their 50s that are still working. And they're usually the couples that, the kids are out of the house, maybe they're, past university. They kind of go, they look at their life insurance, they cancel that. They don't really need it anymore. They don't see a ton of debt. But if you're still working, usually you still have a need for disability. So what happens is, some of these couples are, we don't need it, or they leave their nice executive position to go do some consulting and don't always get that disability to go along with that. And what happens is those last 15, 10 years before retirement, we find is when these, a lot of Canadian couples are really, really starting to put money away. They're trying to play catch up. For all those years they had their kids and they were, weren't able to save quite as much. Now they're playing catch up. Well, what does that look like? If you're putting $50,000 a year and 10 years before retirement, you now can't work, that's about $500,000 impact
Yes,
by
and
age
people
65.
hadn't saved that much. They're not planning that far in advance. Now, a lot of people do have disability coverage through their employer. Not everybody does. And if you're a business owner, you won't necessarily. You need to buy your own. What does disability income cover? Because it's not necessarily going to replace the whole amount that you're used to making when you're working, is it?
Right. Honestly, it all depends. Everybody's plan is completely different. If you're a higher income earner, sometimes you don't have as much income covered. And it's really important to see not only the amount. So a lot of times we look at, I've got, $7,000 of disability. You know what? If something happens, we can live with that. I have $5,000. Yep, I did my budget. We're good. Sometimes you got to look at the definitions. So a lot of times it's the first 2 years, it will cover you for your occupation, but then after those 2 years, it's any occupation.
Oh, that's a big difference, because your occupation, you may be a senior executive or have a high position within a company, but any occupation, am I right in thinking if I can flip burgers after 2 years, maybe mentally I'm not there to be an executive anymore, I may not have any coverage.
And group insurance is a little trickier. The claims can be a little bit more difficult than an individual-owned policy. An individual-owned policy is going to have a stronger definition, stronger contract. And what's tricky with disability, especially as an advisor, is, meet clients that say, I have disability, I pay $13 a month. Well, right away, I'm really worried, right?
That's too cheap.
Cheaper is not always better, right? If me and you, Sybil, are going skydiving, I'm going for the most expensive parachute, just saying, So same thing with disability. It's your parachute. It's really going to be catching you if you can't work, if you can't do your job. So sometimes we can look at the definitions within your group plan and either augment that or at least know what you're covered for.
Okay, and I think that's the key thing there, Karen, is our viewers, I want them to walk away from today's segment double checking what kind of disability coverage you have in place today, read the fine print, and review it with a professional. And not sure if you have enough coverage? We have a disability calculator available on thewealthylife.com. Karen, this has been great. Fabulous having you here today. Thank you for sharing this information.
Thanks, Sybil.
And don't go away. When we come back, find out how you can protect your assets in divorce.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Are you recently married, about to get married, or in a common law relationship? Do you have a prenup? Family lawyers Emma Neary and Bianca Kendrigan are here to tell you why you need one. Welcome to the show, ladies. Great to have you here.
Thank you.
Thank you. It's great to be here.
Bianca, I want to start with you because you've got an interesting story on how did you get into family law?
Yes, I studied theater in New York before going to law school. I was married there, I had a daughter there, and I came back to Canada to BC when I was getting divorced. I started doing some of my own work. I had lawyers in New York and BC, and it started getting expensive. I started doing my own work, helping with affidavits and research and whatnot.
Okay, no, not everybody does that.
And then I ended up, one of the lawyers suggested that I should actually look into doing this for a living, and so I ended up studying for the LSAT and going to law school with my daughter in tow. So that's the story.
Wow.
And family law, because that was what I was most familiar with, and I actually they helped me, and I like doing what I do because I feel like I actually help people get out of bad situations.
Well, you've been through it,
I've been through
it. Oh, wow. Emma, let's talk a little bit more about prenups, marriage agreements. Mm-hmm. What are they?
Well, so in BC, we refer to prenups as a marriage or a cohabitation agreement, depending on essentially whether or not you're married. And it's an agreement for couples to enter into that sets out how they want their property, their debts, and other issues such as spousal support to be determined in the event that they separate.
Now, is it similar law across Canada, other than Quebec? I know Quebec is a little bit different, but are most of the provinces aligned?
They're mostly aligned. There are some small differences between them, but these agreements are done in every province. The courts have slight differences in how they might review the agreements and different standards, but the principles are largely the same for what should be included in these types of agreements.
So most people used to refer to it as a prenup, but it's really a marriage agreement or a cohabitation agreement.
Those are the BC terms. If you call a lawyer asking for a prenup, we'll all know what you're talking about.
So Bianca, should everybody have one? Is this, or who should and who shouldn't?
So, I mean, we recommend a cohab or a marriage agreement for anyone who has assets. It's almost a regular part of your financial planning. You do your will, you do your power of attorney. The cohab is just that one extra step that offers, a little more protection for your assets and what's going to happen, as Emma said, should you separate. And
How often does that happen?
Which, yes, Emma knows the stat.
Well, close to 50% of long-term relationships do end in a separation or divorce. The stats are a little bit outdated on that, but that's the most recent information that I could find.
Wow.
Yeah.
And you don't need to be married to have one of these, right? Because it's the common law. And maybe we should touch on a little bit of common law. Bianca, do you have to live together to be considered common law, typically?
That's a great question. No, and there are a list of factors that are considered, and what the courts are looking for is whether or not people are in a marriage-like relationship, and that's the language we use. So there have been findings where two people have never actually lived in the same residence or cohabited and are deemed to be living in a marriage-like relationship. So you do not have to live together. There are many factors. Intermingling of finances is actually one of the very, very strong factors in making that determination, but it's all on a case-by-case basis.
Okay, so really, if you're in a relationship, you should be looking at this. What if you've been married for 10 years?
It's never too late to get these agreements. We recommend them for people who are really at any stage of their relationship. It's very common for people to come in to see us after they've been married for a period of time or in a longer relationship.
So how do you go about bringing that up with your spouse?
Often there is some type of life event that's spurring things on, such as an inheritance that's coming to one of the spouses. Okay. And there's a discussion about, we're going to use this money for a family purpose. We're going to, pay off our mortgage, invest it. And essentially what you're doing is making an agreement about what is going to happen to those funds in the event of a separation. Because we can tell you that on the other side, when people separate, one of the biggest things they're fighting about is how to trace what happened to that money.
Okay, so if I can have a triggering event, then I don't have to feel awkward asking my husband after 30 years, why we should get a marriage agreement.
Triggering events make it a little bit less awkward, I think. But it depends on the parties.
What are the three main things that should be considered in a marriage agreement?
Division of current property, how you want that to be dealt with. Division of future property, so property that you acquire together and both contribute to. Also, you should touch on whether you want to predetermine what might happen with spousal support in the event of a separation.
Right, so if people can imagine you've gone through the unfortunate situation of a separation, what's going to happen to income, what's going to happen to assets. And those are definitely some starting points. But I know there's a ton more that you guys want to include in a marriage agreement, and we've only covered a few today. But you've given us a list of the 10 things to include or consider in a marriage agreement. We're happy to share that with our viewers. Just contact us at thewealthylife.com. Thank you both for being on the show today. That was so fascinating. I feel like we could spend an hour talking about it.
Oh, more than that, yes. And when people come in to meet with us, that's usually how long they spend with us for the first meeting.
Yeah. Well, thanks you both.
Thank
you.
And after the break, find out how much you need in savings to retire comfortably. Welcome back. Thanks for your emails, tweets, and messages. Today's question is from Antoine. Dear Sybil, we are 65, newly retired, debt-free, and own our own home. We have an investment portfolio, but aren't sure if it's enough to live on for life. How much should we have in savings to ensure a comfortable retirement? Well, Antoine, great question, and congratulations on your retirement. It may have been a little easier to ask this question a few years ago, but it's never too late, because maybe you can save a little bit more even now. There's a number of variables to consider before coming up with the answer, how much do you need in savings? One, what is your income needs? What's your lifestyle? How much are you spending on a monthly basis? I would encourage you to complete a cash flow snapshot just to have a look at what you really need. Then have a look at what other income sources are you currently generating. Maybe you've got a rental suite in your home. Maybe you've got a pension from your employer or a government pension that will top up your income. On your investment portfolio, you want to consider what is the rate of return you are earning on your money, and what do you expect inflation to be going forward? Because if you tell me that you need $40,000 a year to live on today, you're going to need a lot more than that 20 years from now to keep up with inflation. And finally, do you have any estate wishes? Do you want to leave some of your investments behind for beneficiaries? And if not, then we get to plan to spend it all for you. So let me give you an example, because I don't know some of these details about your specific situation. If you earned an average of 4% rate of return on your investment portfolio, and let's assume a 2% inflation rate, so you're going to give yourself a raise of 2% every year going forward, and you're going to want that income to last for 30 more years, then a $1 million investment portfolio in savings would generate $44,000 a year. And if you were only earning 2% on your money, then that same $1 million would generate about $34,000 a year. So hopefully that helps answer your question. And to be more specific, go to thewealthylife.com and plug in some numbers in our retirement income calculator. And that wraps up this edition of The Wealthy Life, helping you make smart financial decisions. Join the Wealthy Life Club by becoming a member at thewealthylife.com. You'll get access to everything you need to live a wealthy life.